Hello and thank you for joining us today. Is this loud enough? Thank you to Vanelli's by the Lake for hosting us today. We are going to, and thank you to the sponsor, First Resource Bank. Yay! I know everybody's eating, aren't you? I'm sorry. All right. Introductions. The name of the game for the chamber is we promote and support each other. So we get to do that by getting to know each other. So we'll have somebody start us off and then stand up and your name and your business that you represent. Who wants to start us off? Kelly, Chad.
I'll start out. I'm Kelly Dunn with First Resource Bank. Pleased to be the sponsor today, and we will hear a little more from you a little later on.
Good afternoon. I'm Deb Bartoletti, and I am an employment counselor with Washington County here in our Forest Lake office and also part of the Workforce Center.
I'm Jenna. I'm the Youth Enrichment Assistant at Lakes Area Youth Service Bureau.
I'm Dustin Wright. I'm with the Verizon store right down the road. You guys need Verizon? No time.
Isn't there a special going on?
There is a free special right now. Until the 17th, we have tablets. You have Verizon right now. It's $150 for a 7-inch tablet, and you get it's $10 a month. You get $150 back, so the tablet's actually free. So if you bulk your mobile payment systems for work, or if you just want to have something that you take on the go that's a bigger display to show your customers, it's free.
I'm Mike Cannon. I'm with Wilcox Chubb Cadillac, right across the bridge, and glad to be here. Thank you. I'm Peter Hasselquist, also with Wilcox Automotive. Likewise, like you.
I'm Matt Wilcox from the dealership. These two.
I'm Chad Swenson, CarX, Forest Lake, here in town. So your car breaks consuming.
Lee White with Wilson Sewer Service, also excavating service, celebrated 60 years this year.
I'm Louise Olson. I work as a business service specialist covering businesses in Washington County to the work much better.
I'm Diane Beach, and I work Central Bank at Forest Lake.
Tom Campbell with First Resource Bank.
Ben Olander with a company called Reliant Financial Services, LLC.
I'm Chris Kay, and I work for a company called Smith.
All right. Thank you again for joining us. What's happening Saturday? What starts Saturday? Flake Fest, the 5th annual. Thank you, ladies. We're selling $5 Flake Fest buttons. We have some here. There's great discounts. You can actually go to CarX and have a 10% discount when you purchase or are wearing a Flake Fest button. There you go. The Polar Plunge is coming up. If you want to plunge on behalf of the chamber, I know Ben Blum from Running Aces would love to have you participate on her team. And yes, the medallion hunt starts. Clues are posted at 8 o'clock on Saturday on the Forest Lake Chamber website, the Forest Lake Times, and the City of Forest Lake. Am I forgetting anything? And it goes until the 23rd. The schedule of events is on our website, so check it out. Wilcox, thank you for your sponsorship. CarX is a sponsor. Who else? Did I miss anything? Anybody? No? All right. So I'm going to introduce Kelly Dunn, who's finishing his salad. I'll let you finish that. There's like 2 bites. Are you sure? Okay.
Very good. Well, thank you. We're here today to talk a little bit about financing. The good news is, from an economic perspective, the last few years, each year has been better than the one before. Businesses are now to the point where they're starting to consider their projects to either span. Some businesses are starting up. Unemployment has continued to decline, which is a good sign. Stock market has held up, which for all of our retirement assets is always a positive sign as well. And so today what we're going to do is we're going to talk about financing your business. And for business owners, a lot of them are good at what they do, but sometimes when it comes to asking for money, they need a little bit of help. Maybe they work with their accountant or their attorney, or hopefully they have a good relationship with a professional banker that can help point out the options that they have available for them. So in today's format, what we're going to do is I'm going to have each of them introduce themselves, talk a little bit about the types of loan programs that they offer. Then what I'm going to do is I'm going to throw out some scenarios and basically try and see, do some of these loan programs fit that particular type of scenario or not? And then we'll open it up at the end for some questions and answers in case some of you came in today with a specific question. So I know that you heard their names before, but we'll kind of have them reintroduce themselves, tell them a little bit about themselves and their organization that they represent.
All right. I'm Tom Campbell. I've been in the banking industry for a little over 15 years. I've been a lender for the last 12 of those. With First Resource Bank, who came up into this area January of 2012. So just over last 2 years spent with them. We're a community bank looking to offer full range of lending opportunities for you. And I will pass it over to Ben.
Okay. My name is Ben Olander. I own and operate a company that I started actually a couple of years ago called Reliant Financial Services, LLC. And what we do is we provide loan application packaging and other related services. We work with the banking industry and their small business and middle market company customers. My background has been banking my entire career, and I hate to tell you how long I was a banker, but I was a banker for almost 40 years, and made it most of those years in administrative or managerial positions, but I've always carried a business banking portfolio, so I enjoy lending and dealing with small to medium-sized companies. That's what I've done during most of my career. I've also had the opportunity to start and run 2 SBA lending departments for community banks in the Twin Cities. And I've always enjoyed SBA lending. I've seen it as a tool, SBA being the U.S. Small Business Administration and their support of the small business community. So that gives you a little bit of background. And with that, I'll turn it over here to Chris.
Good morning. My name again, it's Chris Kay, and I work for a company called SPEDCO. SPEDCO is a nonprofit, and we are licensed by the United States Small Business Administration to manage one of their loan programs in this area. It's called the SBA 504 loan program, and it's used primarily for financing the purchase of owner-occupied real estate or large fixed assets. I've been with SPEDCO for about 3 years. Prior to that, I was a vice president for a local bank, and I have been in commercial lending since 1988, and I've worked in banking since 1984. I would never dare say I've seen it all, but I've certainly seen my fair share. Thank you.
Ben, maybe could you talk about the SBA 7A program?
Sure. SBA 7A, I might kind of revert back a little bit. The SBA established lending programs and supporting small business back, I believe it was in 1953. And they developed a program where they don't necessarily lend the money directly, but they support the banks with guarantees. Currently up to 75%, between 75 and in some cases even 85 and even 90% on certain types of loans to small business customers. And what that does is to enable the bank to support the business community on loans that maybe they don't necessarily feel comfortable doing because of the additional risk. And we'll talk a little bit that maybe on the case studies would be a good time. The SBA has recently revised their programs fairly substantially, but in a positive way. It started January 1st of 2014, about a month and a half ago, and we'll be talking a little bit about that. They kind of work on loans up to between 25, let's say 25,000 to 350,000. They used to call them small loan advantage programs, and they've made it easier for banks to do those types of loans. And then they have a slightly different program and underwriting criteria, if you will, on loans over $350 to $5 million. So the SBA 7A program, it's a section of the Small Business Act of 1953. That's why they call it 7A. Really can handle companies that are fairly substantial with needs up to even $5 million, but as low as maybe $25,000. There are a few other programs that they consolidated in. There's a couple of pilot programs on community lending, the Express Loan Program that Tom will talk about. Trying to think of what else I'm missing here, but it gives you some idea, and it really helps companies right now. We've gone through a tremendous recessionary period. Most banks, all banks have been battered to some degree, and now the economy is improving, and the 7A program is becoming very valuable to businesses such as yours.
The SBA Express program is it's a SBA feature that's got an accelerated turnaround time for review. So by the time the bank makes their decision and they turn everything into the SBA, there's a 36 hours they'll tend to get back to you. That is the amount they will go up to is $350,000. That the guarantee they offer back to the banks is a 50% guarantee on that. The eligibility decision is made by SBA Express qualified lenders. Those can be found on the SBA's website. They can do revolving lines of credit as well as some regular term loans on there as well. So basically your regular forms that you're going to have with the bank, with the exception they're going to have an additional SBA 1919 form that is turned in, that they'll get back to you on that. The credit decision comes back to the lender as long as you pass their qualifying standards and a few of the guidelines set up for that program. It is kind of basically very similarly set up, their standards, with the 7A program.
Forgive me, when I had a chance, I should have expanded on the SBA 504 loan program a little bit more. As Ben was talking about the 7A loan program, where the SBA provides an additional guarantee on a loan that's made by the bank, on an SBA 504 loan, the SBA partners with a bank and makes an actual loan alongside the bank. Classic example of that would be an auto repair facility that would like to purchase their own building. Let's say the building costs $1 million. If they go into a bank and ask for traditional financing on that, the bank is going to ask them to put down 20, maybe 30% equity into the building. For some businesses that may be unattainable, but the business has the sales and has the ability to grow. They just don't have the capital to buy that bigger building right now. Well, the terminal financing with an SBA 504 program would be as follows. The bank would make a first mortgage loan for $500,000 or half of the purchase price. The SBA would come in and make a second mortgage loan behind the bank for $400,000. And then the business owner would only be required to put 10% down into the building. They could retain more of their capital to fund their growth going forward and to hopefully hire more people. That SBA 40% second mortgage will always have a fixed rate of interest on it. Right now, that interest rate is about 5.5% fixed for 20 years. So it insulates the business owner from some of the interest rate risk that we anticipate over the next several years, and it also helps them to get into that building for a lower down payment.
So if a business owner or somebody wants to go into business decides that they're trying to look at some financing, First thing they need to do is really kind of gather some of their historical financial information. Typically, the banks, and it doesn't matter, there's actually a number of good community banks here in the Forest Lake area, some good large national banks as well. That gives some good competitive offers on different business financing requests. So what they would do, if they're very comfortable with their financials, they can gather the information on their own. If they're less familiar with the process, they might want to talk to their local accountant that helps them with their tax returns. Put together kind of a package of information. It would include typically 3 years of tax returns or financial statements on their business, because that sets the tone to show how profitable is the business, how much cash does it generate. They would want to kind of outline what they're going to use the money for. So they might say, okay, we need, to use that example, we need $1 million to build a new building or buy an existing building. So really make sure that they understand how much they want to borrow and what they want to use it for. From there, that's probably a good starting point to kind of, they're fairly prepared on that. Maybe also for all the owners would want to look at putting together a personal financial statement. That can be done a little bit later as well, but making sure that that's something that could be done fairly quickly. Then at that point, there's a lot of local banks in town. They would make an appointment with a banker, sit down, kind of explain what they want to do. It might be for buying some new equipment. It might be for a revolving line of credit. Could be a floor plan line of credit. A wide variety of things that the banks in the area can really help businesses do. Sometimes there's actually some city programs as well, but maybe the starting point is to see what can be done more in the private sector. From there, they meet with the banker. And at that point in time, the deal starts to get talked. There's some conversation going back and forth, and then it's a try and say, well, maybe in this case, the bank will just do it on their own. You know, the track record is good. The business has been around for 60 years. You can show that you can repay loans, and it might be a pretty simple, straightforward transaction to do just a regular bank loan. On the other hand, maybe one of the SBA programs would offer some additional benefit. And so today what we're going to do is I'm going to throw out to the team here some scenarios that I've come up with, things that I've heard as a banker in my 30 plus years where, what is it that somebody might come in and say? Because many of you maybe have bought a car, you've bought a house, so you're kind of familiar with, basic retail credit products. The reality is a vehicle loan for a fleet of trucks is just a big car loan. A commercial real estate mortgage is just a big house loan. And a line of credit is kind of like maybe what you have for your line of credit with your checking account or maybe a credit card. So there's some familiarities, but there's also a lot of specialization going on. So let's say the city of Forest Lake has done a good job and they've recruited somebody new to the town, and that business wants to move into the area. They need $750,000 to buy land and construct a building. Then they also are going to put $250,000 of new equipment in there because they're going to bring some equipment from their old building, but also buy some brand new things. So at that point, they're going to have at least a couple $100,000 of proceeds from the sale of their old building. So they're not coming in looking for 100% financing. So again, kind of looking about total borrowing needs of about $1 million. And we're going to kind of walk through the group here to see, okay, how would you structure a deal like this? Now, in this case, we're assuming that when they dig into the numbers, that the business has been profitable enough to repay the loan. Because sometimes you can't do it. I'd like to buy the Metrodome or something and put in a new stadium, but I don't have enough capital to build a whole new stadium, so not something I can do. But let's start with this $1 million request. Maybe approach it to see what programs you think you would structure through yours. If you've talked about a few different ones, if you think they would apply for all or some of it.
All right. So how we would look upon that is basically two different structures in there, where you would take out the $250,000 loan for the equipment. We'd kind of set that up on a separate side, which would be a termed out deal, possibly 5-year termed out deal there. And then also set up the $750,000 On a construction note, they're looking at building there to, depending on the term of the build out, would be either 6 or 12 months, and then looking at having some permanent financing set up beyond that. The commercial side, typically be looking for 15 to 20 year amortization on the permanent side of the financing there. Where the construction side, we could look at just doing interest only for the construction period until it is finalized.
Well, I'm going to, since my focus is SBA Section 7A, the guarantee program, I'll kind of focus on that. There's a similar program. We'd probably break it down into two loans, the $750,000 to buy land, construct a building. There's a portion of that $200,000 in proceeds that would need to go in as a down payment. The SBA loan could be structured up to 25 years. On monthly payments, it'd be a fully amortized up to 25-year loan, if that's something the bank feels comfortable with. The interest rate could be fixed or variable, and there would be a construction period on that loan, let's say up to 6 months, in terms of getting the building fully constructed. That can be done under the SBA loan, or it can be done on a separate construction loan. That loan would be 75% guaranteed to the bank, which would be positive from the bank standpoint. The equipment loan is the term of that loan. There would need to be possibly a down payment out of the $200,000. If they had additional equipment they'd be bringing with them, there might be a need for either evaluating the net book value of that equipment from a tax return and a depreciation schedule, or an appraisal, most likely an appraisal of the existing equipment they have. And let's say the appraisal had a liquidation value of X dollars, then of that $250,000, the SBA can lend 80% of that amount. But if they didn't have equipment, they'd have to put some of that $200,000 into it for a loan-to-value. What's called a loan-to-value ratio, the amount that you lend versus the value, needs to be 75% on buying new equipment. The loan could be repaid anywhere from 48 months, maybe longer. It could be up to 84 months. That depends on the expected useful life of that equipment. It wouldn't make sense to do an 84-month loan on equipment that's only going to last 48 months. That's not good for the company. But if the equipment's going to last 84 months or 7 years, then why not do a 7-year loan, potentially, or less?
Certainly, the 504 would be a wonderful financing tool for the permanent financing on the building. The SBA would not finance during the construction period. The bank would do a construction loan until the building is complete, and then when it's complete, then the borrower would institute their permanent financing on that. On a $750,000 building, assuming there's nothing special about the building, that it could only be used for one purpose, assuming it's a general building, we could finance 90% of that. So that would be, $675,000 on that. The permanent financing on that would be the SBA at $300,000 and the bank at $375,000. The SBA piece, as I mentioned earlier, would be fixed for the full term of 20 years. Now, the other question that I would ask would be regarding this equipment, what kind of equipment is that? If it's long-term equipment, say for our auto repair facility, maybe these are lifts, or these are big pieces of equipment that have a long, useful life and become part of the building. In that case, I would take those assets and I would roll them into the project and try and finance those on the 504 as well. Some of the shorter-term equipment, I think a 7A would probably be a wonderful tool for that. So we could potentially see a scenario there in number one where we would have combined financing of 504 on the building and the big long-term assets, and a 7A on the more shorter-term assets. Potentially we could get this person into this building for $75,000 on the building piece of it, and whatever the bank feels is appropriate for a down payment relative to the equipment piece. and they would still have some working capital to finance the move and to finance the the hiring of new people and the purchase of new inventory and all the unexpected expenses that come along when you move a business.
So we can see on an example like that, the good news is there's lots of programs that could be done. Everyone is probably done a little bit differently. There's still an art left to commercial lending, and that's where you really have to start. Try and look at what all you're trying to do, and then you try and piece together the best one. And it may be just a commercial loan from a bank. It might be 504 with a bank loan. It might be a 7A bank loan. So it kind of all depends on that specific situation. So at least that was a good one to start out with because it does demonstrate that a lot of different ones we're doing. Now let's say you have an existing business here in town and they want to add on to their building, put on another, let's say, $200,000 addition and buy $300,000 of used equipment. So maybe just briefly kind of say is that a similar process as the one we just described, or are there some differences? So again, it's an expansion. And for the sake of it, let's say they currently don't have a mortgage on their building. So,
Well, looking at that, say they're an existing customer. If we're don't have an existing mortgage on there, that would be able to play into a factor that we could take a mortgage on that as a refinance.
you might be able to do 100% financing.
In that case, depending on the equity position on the building, we could do up to 100% financing on that. Otherwise, we'd be looking at the equipment, depending on which type of equipment it is. We'd have to figure out the loanable value on that and and basically go off the loanable value, depending on how old it is, as it is used equipment, how much life expectancy is left out of that, and set that up on a term loan with a fixed rate is what we'd be looking at there. If there is available to take out a mortgage on that, we could look at putting out that amortization period a little longer to help with the cash flow situation that they have there.
Okay, in terms of the 7A program, which is what I'll focus on, both the new construction, and we're assuming that there's no prior mortgage. It's possible of a 20 to 25-year fully amortized loan. It depends on how new the building is. It generally would be a new building for 25 years. Interest rates are currently very positive, so the longer a lot of customers would want to try to lock in somewhat of a fixed interest rate, if at all possible. The used equipment, again, as Tom had indicated, we need an appraisal on that equipment, an equipment appraisal. And from the SBA standpoint, you'd be looking at 80% of what's called the liquidation value, up to 80%. There might be existing equipment that could be used as collateral also, so that the customer can use existing equipment plus purchase the new equipment and not have to put any money into it. The term of the loan is going to be based upon the expected useful life of that equipment. If the expected remaining life of that equipment is 5 years, maybe a loan up to 5 years might be appropriate.
As a general rule, financing expansion of a building with a 504 is definitely eligible. It becomes a little more complicated if there is some existing debt on the building, but it's certainly not a challenge that's insurmountable. I believe that my comrades here, for example purposes, have based their structure on the assumption that there is no prior mortgage on the property, in which case utilizing a 504 to do that expansion would be quite simple, and we could utilize their equity in the building as their downstroke into that. Now, the $300,000 worth of used equipment, my question on that would be what kind of equipment is it and how much life is left in that equipment? the amortization or the loan term should not exceed the useful life of the equipment that you're financing. The shortest term that I could go on an SBA 504 is 10 years. So if it's equipment that has a remaining life of less than 10 years, then a 7A would probably be a much better solution in that case.
Okay, let's say we have more of a newer business coming in where it's a spa, and somebody wants to open up a salon and spa, and they need $75,000, with the majority of that going to leasehold improvements. So we're going to, again, have you guys comment on whether or not you think your program would work for something like that. So we'll start on the other side. Give Tom a second to think about that. $75,000.
A $75,000 loan for leasehold improvements would probably not be a very good match with the SBA 504 loan program. Our minimum loan size is $50,000, and 40% of the $75,000 just wouldn't reach that mark. I think a 7A would probably be a better solution.
I would agree with that, Chris, that 7A might be the right solution. This is a startup, brand new business. It doesn't have any history of repayment. You can't go back 3 years and look at their earnings to see whether it's, if you project the history out, can it repay the loan? So you're kind of speculating or guessing and looking at the management of the company. There would need to be a business plan. There would need to be projections. The individuals, the owners of the new spa would need to have some experience and capability of starting and running a company. There would also need to be some upfront equity of their own that they would need to put into the business. That could be up to 30% of what we call the source and use of funds, or the total amount of money that the company needs. So they would need to put some of their own money into the business in addition to for operating capital or working capital until the business is up and running and profitable, and maybe for equipment or furniture besides leasehold improvements. This type of loan can be done under the 7A program. And I mentioned the equity that needs to be put in, the projections, the business plan, which is important to help make it successful. SBA does not turn down a loan because of a lack of collateral. Leasehold improvements are generally given very close to zero value from a collateral standpoint, because if the business is faltering and doesn't make it, then the bank would theoretically need to repossess its collateral, just like repossessing a car on a personal loan. And how do you pull out the carpeting, take the wall coverings off? There might be some fixtures maybe that the bank could acquire, but the landlord's generally not going to be very happy about having their building ripped up, if you will. So it's generally not given much from a collateral standpoint, but the SBA program would work for this kind of situation. The SBA would require that the bank that does the loan, the lender, needs to look at the personal assets on a personal financial statement provided by the owners. And the biggest asset they would look at is taking what's called a junior or a second mortgage on a residence. And that would be, if there's adequate equity, that would be required. So a startup is more difficult. There really isn't any collateral here. They would need to look at the personal assets of the owner and go from there.
Yeah, to echo what the other two said, being a startup, it is a tougher deal to get off the ground. And as Bennett said, being leasehold improvements, the value in the leasehold improvements as far as the bank is generally looking at them is pretty close to zero on there. So we would be looking at the owners or guarantors to produce something of value to put up that we could take as collateral.
Okay, so we've looked at some that are easier to do, some that are a little bit tougher. Now, we live in a global economy, so let's say that we have a business up in Wyoming. Let's say that they're on the internet and they have a fantastic product. And all of a sudden, somebody from Germany contacts them, and they really like this, and they want to buy some things from Wyoming here, and so as a result, our business comes in and they say, gee, I need $300,000 to buy more inventory and then to carry some of these receivables from this German company. So again, we'll start down with Chris, and how is that even appropriate for your program?
The SBA 504 loan program is utilized to finance fixed assets, real estate or equipment. So in this case, what they're really looking for is some working capital financing to finance the receivables and the inventory, and that would not be a matched use of funds for our program.
Well, luckily, the SBA has focused very, very strongly and put a lot of their own resources into international lending types of programs. They've got several different programs. The main one that would work here is the Export Working Capital Program. It offers up to a 90% guarantee for the bank. A loan on the full $300,000 or some portion of that might be available for up to 12 months on possibly on a revolving line of credit basis. Receivables, even foreign receivables, some of which could be insured through the Import-Export Bank, can be financed as part of this. Those receivables, when they ship the product, the German company is going to owe them the money they may not pay right away. That would be the receivable. And the receivables that can be financed, there's been a change in the program. It's now 60 days due or less that can be financed under this program. The bank can use its own credit decision process and loan documentation. And as I mentioned, the SBA provides substantial export assistance and training to companies. So it's just a major focus of theirs.
We as a bank would typically not consider the receivables, the foreign receivables, as an asset that we would be able to lend off of, just because the collection efforts are a lot tougher going to a foreign place to try to collect them. Although we would definitely be able to look at, and hopefully they have some additional room with what they currently have, that we could take a look at their existing equipment and their receivables, where they're sitting at currently.
So again, sometimes the details make a little bit difference, meaning if you're selling to a U.S. company, that's maybe a little easier to do, but if you have foreign receivables, I know also state of Minnesota has a trade office, and generally we would try to bring in somebody from them to help us come up with some good solutions. So now let's switch gears. Again, everyone's into technology a little bit, and let's say that we had a startup software development company. They've got the next big app that's going to go into the iTunes store. In the meantime, they need to buy about $150,000 of computer hardware, servers, software. So, a pretty big investment to do that. Plus, they need another $50,000 to build out their website. So, it is a startup. So, what do you think about that?
Okay. On the startup, we'd be looking to make sure they have a very good plan to go ahead, business plan that they're looking at. On the inventory, we'd be looking at them putting roughly at least 20% down on the new inventory. And also be looking at about a 3 to 5 year term deal on the inventory portion there. The website alone, we would be looking at them to produce more of that funding by themselves, as it, again, doesn't really produce collateral value to the bank when they're going back and look at that.
Well, as I mentioned before, the startups are a little bit more difficult to finance because they don't have a history of earnings for that particular business, and it's just a brand new business that's starting out. But it can be done under the 7A program. one of the positives is that for loans of $150,000 or less, which this would be less, very possibly would be less than 150, the guarantee percentage is 85% to the bank. Also, the SBA just recently came up with a change in their program to where they've eliminated fees both to the bank and the borrower guarantee fees for loans of 150 or less. So they're really focusing a little bit on the smaller loans. The collateral offered here is considered, just to be honest, from a banking standpoint, relatively weak. That's where an SBA guarantee can come into play, is when you have weaker collateral. Computer hardware and software generally doesn't have a lot of collateral value in the way that a banker would tend to look at it. And the need to develop their website is working capital, operating capital, $50,000 for a website. If the business failed, the website probably wouldn't have any value. So the owners would probably need to put in at least 30% of the total need of funds for the company. And again, we'd need to look strongly at their business plan, their past experience in this type of industry and their capabilities, and their ability to put in some equity. Also having some personal resources beyond the equity they put in, so that if something happens in the future, the bank maybe can't lend additional money, they have some liquidity or some personal resources in the future that they could possibly put a little money back into the company if it's needed. The final thing is, again, looking at the personal resources of the owners who need to guarantee the loan. And that might include a junior mortgage on a home.
While the SBA 504 loan program would be more than happy to finance a startup type operation, in this case, again, we have assets that I just don't think have a long enough useful life to qualify under the SBA loan program.
At this point, we're just buy the equipment. So it was software and hardware initially. So. And again, different things, but just trying to say, how would a startup technology company, can they use some of the financing? So now let's say that people are excited about spring coming. We have an existing snowmobile dealership. They want to add on to their dealership with a new showroom, and then they're going to add about $700,000 of new Indian motorcycles so that they can start having that. So they need a floor plan for about $700,000 of motorcycles, and probably the cost they're estimating for their new showroom expansion is about $500,000. So do these programs work for a floor plan? And I think we know that they do for the building expansion, but what about a floor plan?
On the floor plan, we could definitely do something there, and each floor plan could be set up a little bit differently. Typically, your floor plan covers interest only monthly with a separate curtailment payment, which would be a portion of the principal balance outstanding on there for the existing vehicles out there. So I mean, the showroom, we would just set up, or the floor plan, be looking at setting up a certain portion of the value of them. Typically, we'd like to see some money down on them, but again, each case is a little bit different. But yeah, I mean, up to 10% down would be coming from the borrower, and then we'd have specialized repayment methods depending on the situation.
Well, the SBA and I don't know for how long, maybe the last 5 years or so, they started a pilot program on floor plans, and it was utilized. As you know, during the recession, we just encountered that the auto industry was hit pretty hard, and so they set up a pilot program of guaranteeing up to 75% on a floor plan lines of credits that banks could do. They're either in the process or have eliminated that with the change here, feeling that maybe the auto industry is strengthened enough to where it can kind of work conventionally with the auto finance companies or through commercial banks. So it's not really available right now, or will not be available shortly on a guaranteed loan basis. The building obviously can be done under a 7A, similar to what we've talked about before.
Excuse me, what do you mean by
Yeah. A floor plan would be financing individual vehicles of some sort. It could be boats, it could be automobiles, it could be snowmobiles, it could be Indian motorcycles, and those vehicles are going to be turning constantly and sold. And so it becomes a little bit cumbersome and complicated. You have to have expertise in financing those. It's generally set up on a line of credit. It might be $1 million, $2 million line of credit in some cases. It could be much higher, it could be lower. And the line is paid down when the individual vehicle, if it's a motorcycle, the motorcycle is sold, the money collected, they pay down. But then they get new inventory, a new motorcycle in from the manufacturer, they have to pay for it, and that's paid for through advancing on the line of credit. So it's like a line of credit, and it's a little complicated. It requires more inspections quite often. I think a lot of banks will even do like 13 inspections a year to making sure that they're what's called being in trust, that they, when they sell a vehicle or a motorcycle, that the money is actually applied and doesn't go elsewhere. So, I don't know, Tom, would you want to expand on that at all, or is that?
Yeah, that's pretty much right on. It's mainly reserved for dealerships that carry large inventory that they are constantly selling. So I think Ben did a pretty good job of explaining that. So it's basically the inventory that is constantly revolving in and out of the business.
This might get a bit old after a while, but financing a line of credit is not a 504 eligible use of proceeds. But certainly the expansion of the showroom would definitely be an eligible project on there. Whether there's debt on the building or not, we could likely find a way to utilize the 504 loan program there.
Okay, so now let's say we have a trucking company. All of a sudden, the economy is picking up. They need to buy 6 more trucks for their fleet. So let's say they decide to go with Peterbilt trucks, and I'm just guessing, but let's say they wanted 6 more trucks, and that cost $450,000. How would you finance 6 new trucks for a business?
Well, this deal is pretty much a straightforward. We'd be looking at 20% down on the vehicles and terming them out over about a 5-year period on that. It's basically your typical car loan, just looking at bigger numbers.
Pretty similar on the SBA program. They like to work with 25%, 75% loan to value. But you can take existing trucks. Let's say that they have other trucks beyond the 6 that they're acquiring, and those are, let's say, free and clear, and they're going to retain them and continue to operate them. Those could be used as collateral to mitigate the need for a down payment, and they may be able to finance the full $450,000.
Okay. All right, now, let's say we'll do something a little bit different here. Let's say that you have an existing dentist who's been in town for a long time. They're ready to retire, and they want to sell their practice. And so they negotiate, they find a younger person to work in their office for a couple years, and let's say that she decides to sell her practice to a younger associate, and between the building and the practice, they're selling about $900,000 is the price that they've agreed to pay, of which about $500,000 is for the building and the equipment, and the rest of it is for sometimes called blue sky, or the excess value, because that dental practice that she's had has been in town for 25 years, so it must be worth something. How would you guys finance a $900,000 sale?
Okay, on that one, the sale portion, I think we've discussed in the past. We could take a look at doing the mortgage on on that 500,000 portion. The interesting part, difficult part, is that 400,000 of blue sky, which is basically a projected number that the current owner thinks that their business is worth, even though the equipment and actual physical assets they are selling is only about 500,000. They have built up customers, customer base that is coming in, and that's where they're coming up with this extra 400,000, because they're saying we're projecting you're going to get sales for the next however many years based off of our current situation and customers. So that one is, again, we could be looking at doing a second mortgage on their personal residence of the associate looking at buying that. Is something we would definitely look at. Also, any other personal assets they may have to try to help cover up that shortfall of which they may not be able to put directly that $400,000 down into.
Well, I guess I would be reluctant, I would think most bankers would be a little reluctant to finance the building until the individual that is buying the practice demonstrates they're able to be profitable, retain the customers, and grow that business. It might be a year or 2 years in the business, some fairly short period of time, where they could demonstrate that they're doing well in operating a business. It's a lot different operating a business than necessarily just being a dentist and taking care of the customers. So I would kind of recommend that the building could be financed by the seller, by the current dentist for some period of time, maybe several years, or he can hang on to it and just lease it to this dentist that he's selling the business to, sell the business to them. That type of lending is done with SBA loans all the time, even with intangible value in the business. The SBA has procedures and business valuation items that they work with, and it's very possible to establish that loan. But I would recommend doing the loan as an SBA 7A on the business, and then looking to see if there is any equity that the dentist buying the business can put into it. My guess is this dentist may be fairly young, got out of dental school, possibly has a lot of school debt that they're dealing with, maybe not a lot of assets. In that case, the equity that they would need to put in can actually be supplied by the selling dentist. And there's certain things they can do to put in some equity as part of the sale price. I won't go into detail, but that's done quite a bit as considered as part of the equity of the business.
Ben brings up a number of good points regarding the sale of a business and whether or not it would be prudent for them to jump in and purchase that building right away. But for my example, let's presume that this is an experienced operator and that they have management experience, and we're relatively confident that they can run the dental practice. If they were interested in purchasing that building at $500,000, we could finance up to 90% of that. So they would only need to put $50,000 down relative to the purchase of the real estate, and then we would finance the balance of that. The financing of the practice, that's, in my mind, an excellent example of the use of a 7A. You're purchasing really the individual client files, and while they definitely have a value as a going concern practice, from a collateral standpoint, a banker with a stack of dental files really doesn't have much. The SBA 7A will allow financing to be accomplished even if there is a shortfall in collateral. Now, the buyer would be expected to put in whatever assets they have to try to collateralize that $400,000 purchase. But if they couldn't come up with $400,000 in collateral, the deal could still get done. And that is really a wonderful feature to the SBA 7A. I mean, here's a business that might otherwise be put in jeopardy, and the other employees there may or may not have jobs. Who knows? The transaction may not occur without the assistance of an SBA 7A loan program. So dental practices are a great example for how to utilize that additional SBA guarantee to get a deal done that should get done. But based on general banking regulations, if Kelly or Tom were to put an unsecured dental practice deal out there to a young associate and that got in front of their bank examiners, I wouldn't say they'd be in trouble, but they might have to answer some questions. But having that additional SBA guarantee on there, that deal probably wouldn't raise to anyone's attention.
Okay, so our purpose today was to just kind of describe a few different situations to see how structures could get done. As you kind of see, each one is actually pretty unique. Good news is bankers in town are very willing to visit with people, understand what's going on in their business, see if they can help them grow. Banks actually have a lot of money to lend, so it's actually, if you have a legitimate need, that's something to do. At the same point, coming out of a recession, bankers are still acting like bankers. And I was mentioning a little earlier today that if you think of somebody like Kirby Puckett was an all-star baseball player. He had a batting average maybe around 330, 340, something around that. He made the All-Stars. Well, for bankers to keep their job, we would lose our job if we only guessed right on 1 out of 3 deals. We actually have to be about 99% correct in what we're doing because we're taking people's deposits, their life savings, lending it out to businesses, and at some point we need that money back to pay back those savings. And so keep in mind that that's true. Banks are conservative, but at the same point, that's how banks make money, is by making good loans to good people in town, helping them grow and see what they can do. So with that, we'll kind of open it up to see if any of you, as you thought about the topic today, if you had any particular questions. Glad somebody asked for clarification on a floor plan. We're guilty of this. Every now and then we use a word that we know what it means, but not everybody does. But any questions in general or specifically? Otherwise, I can, yeah. Franchises. That's a great question. And on a franchise program, if you look at the rate of business failures, one way to reduce your risk of failing as a business is if you can be part of a franchise program. The SBA has a list, like they do on a lot of different things, of what they call approved franchises that they're willing to do. So in other words, if it's an established one, for example, let's say I decide, well, I'm going to open up a Subway station. Chances are I could talk to a banker if they wanted to go SBA. There's thousands of Subways around, and I'm very confident that's on that list. CarX, I'm guessing maybe CarX's would be on that list as well. So the established franchises that have been around, definitely that's something that they do. The franchisors provide assistance on how to get financing. They help you put together the bank packages that would make it more likely that you would be approved. And I know in some franchises there's actually even like a national market on people willing to buy those. So it doesn't eliminate all of the risk, but it definitely helps from a banker perspective. It helps mitigate it because we're a little more aware that it's not just Kelly Dunn and his good ideas, but you've got the strength of people who've been in that business, understand the risk, hopefully help you look at the local market to make sure that that's appropriate as well. Good question. Do you guys have any? You've done a lot of franchise deals.
Just a little bit to that. To add just a little bit to that, SBA has partnered. They work with franchises a lot, and they partner with a company called FranData. And this FranData makes very, very good information available online for free to the banking community. And they've got historical numbers on the success rate of different franchises by location, by area. How many of them, when they went into business, how many of them, the average time that they survived, because not every business is going to survive. It might be 1 out of 10 survived for 1 year, or 1 out of 10 in a certain location survived, for 2 years. There's that kind of information is important to the banking community. They also make available the franchise agreements and the Those franchise agreements are approved annually by the SBA. They need to be approved by the SBA, and their legal approval, and that information's all available on this Fran Data site. So they really focus on it. I can get you. Did I send you that information at one point? I may have, but I can resend that to you. It's free. You get in there, you sign up for it, you can get registered, and a lot of information. I'm looking at assisting a bank with Jimmy John's right now, and it's just starting to dig into it. But it's people with great experience in that particular industry. So.
Other questions?
You guys talked a lot about, the support that people might need on the front end of a startup business and so on. What are some of the resources that you guys try to connect people with, whether it be the Small Business Development Center or things like that? Are there resources out there for people that have an idea or a concept about what they want to do, but maybe don't have a lot of business experience?
Yes. One that I've worked with over the years, which is kind of interesting, is called Women Ventures. And they actually do let guys go there too, which is in today's world probably appropriate here. But they're down in St. Paul, right in the Midway area. Women Ventures is one that we as a bank have given some money financially to help support their programs because we feel them to be good, very worthwhile. But they're definitely one of the ones, and we'll kind of share down the list, but that's probably at the top of my list in terms of it. St. Thomas has their Small Business Development Center. They do counseling and have a variety of resources.
I know another one that we looked at was META is out there as one to help some minority groups as well.
Yeah, most of the ones that my customers work with would be the small business development centers, which are spread throughout Minnesota, and they provide assistance with business plans and things of that nature. My company also does some of that assistance in terms of business plans and financing avenues and things like that.
Off the top of my head, I'm not able to think of any organizations other than those that have been mentioned already, but there are a couple of them that were mentioned that are very good resources.
The other thing that really helps is that if we see somebody has been working with one of those groups, then they come in probably 10 times more prepared than just the average person just walking in. So right away, as a banker, you're looking more favorably on their deal because they've got things down in writing. They've bounced ideas off of each other, and a lot of that assistance is available. You might as well use it. The challenge might be that sometimes it takes a little bit longer time because maybe their course or their next seminar doesn't do that. Another one is the Service Corps of Retired Executives called SCORE. Again, very closely affiliated with the SBA. It's another one where you can actually schedule an appointment and have somebody from SCORE maybe meet with you and be a sounding board. All right. Yes?
How is virtual banking affecting businesses
Yes.
as well as banks?
Well, in the world of virtual banking is definitely growing exponentially. And I guess I would go back to, I can think of the early 80s when people, when I was more of a retail banker and we had to bribe people with a Dairy Queen ice cream cone just to try a cash machine. I put my card in and I get money out. And you can tell how, as consumers, that's totally changed it to where now if you buy a smartphone, you can in some cases do mobile banking and take pictures of checks. On a business side, I think pretty much all the community banks have done a good job, and the national banks, in terms of giving good flexibility to people. So, for example, the average consumer has a basic internet banking opportunity to log into their bank accounts. And so maybe if you're working all day, the only time you can look at it is 10 o'clock at night. Well, you can go in and transfer money and do things like that. For businesses, the next level up is more of a business version of that allows you to do stop payments online, initiate ACH transactions, which are electronic payments or receipts, as well as look at doing wire transfers and things like that, and monitor your money, even looking at what's coming in the bank tomorrow, that you get to see that. So from a mobile banking, it's like the rest of our world where there's just more and more information available to you online. Banks need to offer those services to keep up. The challenge, as we've seen with the Target breach, is making sure that those sites are very secure and tested. And no site is probably ever perfect, but the federal government has the banking system at a very high level of expectations for their security and things that they do. I was talking to a customer today who was disappointed with one of our agreements because it spelled out pretty clearly these are the things that they need to do. And I was trying to explain that the government at the federal level relies on the banking system to help to protect against terrorism. And even though we have thousands of good people out there, there's a few bad people that use different banking systems for bad things, moving money to terrorists or stuff like that or drug money and things. So they rely on the banking system to be another set of eyes. And some people don't like that, but at this point, it's something that we're stuck with. So good news is lots of tools out there. Talk to the bankers that you work with, see what they have available, and it's amazing what you can do nowadays. From a business perspective, it probably helps you if you use it a lot. You can reduce interest expense. So in other words, you could set up a program like a sweep account to move money and not just leave it against your line of credit. You could pay it down and make advances every day. So that's a technology of a virtual banking. You have different levels so that maybe the owner of the business can see everything. Maybe a controller can see certain things, and maybe a certain clerk can only go in and pull up this report. So there's that type of flexibility that systems allow as well. So it's exciting, but it's also challenging to keep up with it and and see what's out there. Other questions?
What kind of trends are you seeing in terms of growth in business, capital?
Yeah, good question. Her question is, what kind of trends are we seeing? And as I talk to other bankers on the community, 2 years ago was really 2012 was when we start observing a little bit more of a return to a normal economy. And I would say that definitely picked up last year, where a number of our more commercial customers, as we're starting to see financial information from last year, in general, they had good years. We're actually getting to the point where it's a little bit harder to find good workers. And so all of those trends are out there that I think are good. Businesses, at this point, I guess I would still say, in general, are cautious. I mean, I don't see people throwing money to the winds and saying, okay, we're going to double our sales in 2 years or something like that. They're kind of, I guess personally, I'm a believer that we're in kind of this new normal environment where slow, steady growth is probably more likely to occur than the rapid growth. But in this corridor, as I look at more of the northern suburbs, I think, I've seen around our bank a number of new homes being built in the last year. To me, that's exciting. It's a different company from Mattamy Homes, I guess, but it's fun to just see that kind of activity in our local area, and I think Forest Lake community will benefit because of things that were kind of put on hold for about 5 years, but eventually the Twin Cities is growing. It was just put on hold there, and we'll probably see more activity. And it was nice to see Team Vantage move into the business park, adding a lot of good jobs. Polaris is going gangbusters. So from a banker perspective, I'm excited about the community and the things going on here. Should be a lot of good opportunities for everybody. So at this point, and I think people have learned some lessons from the last time. I think consumers are saving more, not just automatically spending on their credit cards and other things. And businesses, at some point, if they start building or hitting the seams, they're going to have to do something too. And computers need to get replaced. Equipment does wear out. Vehicles wear out. So you can only kind of put off things for a while before eventually some of that will kick back in. So I'm encouraged about what we see. People are concerned a little bit about healthcare costs and some of those things, but at the same point, if their competitors go up and they go up, at least maybe that gives them something to leverage off of, I guess. Anybody else? And I think, Ben, you were saying you were seeing a lot of new deals this year, and Spedco, you're off to a good year, and we're seeing deals. So just compared to maybe 2 years ago, it's night and day difference. It feels a little bit like the the mid-2000s versus the late 2000s. Okay, thank you. We'll turn back over to Colleen.
Well, thank you, gentlemen. Good information, kind of mind-boggling. I'm not a numbers person, so I'm sure these gentlemen, if you have any one-on-one questions, would be happy to stick around. I expect to see all of you on Saturday, Lakeside Park, 8:30 a.m. And then on the 22nd, I'll be watching lunch. So again, if you are interested in joining our team, we'd love to have your support of that. Or else if you just want to make a donation, we'd love to have your donation also. So thank you so much for joining us today.